I think that people would like to believe that Trump will solve the malaise around the American economy. I don't think he can do that. You get elected by making promises to various constituencies. When the bill comes due, it becomes very, very difficult to look after everyone.
Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vierra, part of the outreach team of Silver Bullion here in Singapore, where we want to help you truly secure your wealth. Rick Rule joins us today. Rick is the founder of Battle Bank, as well as the former CEO of Sprott US and president of Rule Investment Media. And we're delighted to have Rick join us once again today. Time to saddle up and silver up for Rick Rule. Rick, welcome back to SBTV. How are you doing?
It's always a pleasure. I'm doing better for being back with you. Thanks for having me back.
Glad to have you back on. Really, really glad to have you back on. And you are waking up to a new president. Gotta ask, what's your, let's just call it, prognosis for a nation that has a new president and at the same time has been sort of in a fiscal health decline?
I'm delighted that 51% of the voters are happy. It's too bad that 49% of the voters are unhappy. I need to say, Patrick, I haven't voted with enthusiasm for a president since Harry Brown. I personally look at politics and politicians of either stripe with some disdain. I remember well H.L. Mencken's admonishment that elections are advanced auctions of stolen property. And I too remember, I guess it was Gore Vidal, that said that you define politics by looking at the root words, poly from the Greek for many, and tick from the English colloquial for small blood-sucking insect. I suspect that people in life who deliver value to other people, producers, will do well, irrespective of who won the election. I suspect that people who just go through life consuming value rather than creating value will do poorly. In other words, life will go on. The issues around gold and silver, I suspect in the very near term that you will see greater U.S. dollar strength and so softer gold and silver prices. In the longer term, I think that precious metals are a reflection in the maintenance of the purchasing power of the U.S. dollar, which I think will be poor. Remember that the on-balance sheet liabilities of the U.S. government exceed $35 trillion. Remember that the deficits are $2 trillion. Remember, too, that the net present value of off-balance sheet liabilities, Medicare, Medicaid, Social Security, federal pensions, exceed $100 trillion. Harris wasn't going to change that. Trump won't change that. So life will go on.
Indeed, life will go on. But Rick, with the Trump win, we saw the markets rise quite a bit. We even saw the dollar rise. We even saw Bitcoin rising to new highs. Is this telling us anything?
No. I mean, no. I think that people would like to believe that Trump will solve the malaise around the American economy. And I don't think he'll do that. I don't think he can do that. That's no criticism of Trump. You get elected by making promises to various constituencies. When the bill comes due, it becomes very, very difficult to look after everyone. Those who are hopeful about politics should read a book by David Stockman called The Triumph of Politics. that talks about the fact that it took 90 days for the politicians to dismantle the Reagan Revolution. The lesson is to go about your own business, invest in high quality businesses, generate more utility for others than you consume for yourself. The delta between what you produce and what you consume is called wealth, and you owe it to yourself to become wealthy. I think that markets are maybe not euphoric, but I think, as an example, that Trump will not dismantle the carried interest tax provision, which means that hedge fund operators are happy. Their taxes won't go up. I think that Trump absolutely will deliver tax cuts. And for upper income taxpayers such as myself, that's lovely. But Patrick, tax cuts without spending cuts are actually fraud. They defer the bill. So in the near term, the liquidity from tax cuts are a good thing. In the long term, they add to the on-balance sheet and off-balance sheet liabilities of the U.S. government if we don't cut spending. And I don't believe that Trump or anybody else, this isn't a criticism of Trump, I don't believe that any of these people have the wherewithal to cut spending. The message is to pay attention to the basics, not to be despondent, not to be elated, not to worry too much about, a floating abstraction called an election, and spend a lot more time paying attention to the companies that you invest in, paying attention to doing your job well, and paying attention to running your own business well.
With what you were just talking about here, I want to stick with the debt for a little bit, and correct me if I'm wrong, but I believe as of end of September this year, the U.S. debt to GDP ratio was at about 123%. 123%. Rick, firstly, when you hear this number, 123%, what does it mean to you? And second, do you see this number rising or lowering?
It means a lot to me. What I've learned in life, both as an investor but as a lender, is that asset values are ephemeral. They rise and fall. But obligation, debt, is fixed, and money good. Specifically, the debt to GDP number is relevant because it means that if we had the replay of a circumstance like 2008, a liquidity crisis, our ability for credit markets to allow us to print our way out of the difficulty, to increase liquidity through quantitative easing, gets less and less. Coming into 2008, federal debt, on-balance sheet debt, relative to GDP was about 40%. That same number today is 3 times higher. The tolerance of credit markets for counterfeiting will decline, which means that our ability, our fiscal ability to deal with liquidity crises declines. Could it work one more time? Sure, maybe. Maybe's a rough word. It's all a function of confidence. We could afford to be more confident when on-balance sheet liabilities were 40% of GDP than we can where on-balance sheet liabilities are 120% of GDP. But people look at these numbers and they think they're abstract. Let's transpose those to a person. Let's decide that your gross earnings for a year are going to be $100,000. And let's decide at the beginning of the period that you have $40,000 in debt. After all of your other expenses, you can likely service $40,000 in debt at a reasonable interest rate. Let's say that, however, 20 years hence that your salary is $100,000 and your debt is now $120,000. Sometimes it's useful to scrape all of the zeros off the number and to personalize the potential impact of the debt. Sometimes that helps people. But Patrick, the second area of concern, And by the way, I'm not one of these doom and gloom guys. But the second part of the concern goes around a number that nobody talks about. That is the $100 trillion in the net present value of promises that we've made to ourselves, entitlements. I believe that we will honor the nominal value of those entitlements. Let me put that in perspective. Some old codger, let's say Rick Rule, 71-year-old guy. I don't know what Social Security has promised me, maybe $4,000 a month. I don't know, $3,000. I have no idea, to be honest with you. Society's going to keep that promise. They're going to continue to pay me my $4,000 a month, but they're going to inflate away the net present value of the obligation. Did you know, Patrick, you probably don't because you weren't alive then, that in the decade of the 1970s, according to the IRS, the purchasing power of the US dollar in 10 years, 1970 to 1980, declined by 75%. I believe that Medicare obligations on a nominal basis and Social Security obligations on a nominal basis and federal pensions and military pensions on a nominal basis will be honored. But I think the purchasing power of those nominal payments will be reduced by 75% in the next 10 years. In other words, some old codger like me will get $4,000, but $4,000 will buy $1,000 in goods and services. That's how we'll deal with the debt and the deficits. So be prepared.
If you're enjoying this interview with Rick Rule and I, please do consider subscribing to our YouTube channel. And if you are a current subscriber to this channel, please do check to see that you are still subscribed and have not been unsubscribed. I myself have been unsubscribed from this channel without my doing or knowledge. But as always, if you have any questions about precious metals, wealth protection, storing offshore, or generational wealth, please feel free to email me, patrick@silverbullion.com.sg, or visit our website, www.silverbullion.com.sg. I guess along with this, I'll ask, are we going to see the return of inflation as these things start to purchasing power diminishes?
Patrick, I would argue that we've already seen the return of inflation. The big thinkers in the world would have you measure inflation as the CPI. We laughingly call that the CP lie. The CPI, when it's inconvenient, doesn't include food or fuel. I'll ask you, Patrick, do you eat?
Oh, yes.
What use is an inflation measure that doesn't include breakfast, lunch, or dinner?
Yeah.
The second thing it does is it doesn't value the cost of goods and services. It assigns arbitrary value to them. It is hedonistically adjusted, meaning that the people who construct the index construct the values. But the silliest part about the CPI is it doesn't include tax. I would ask your listeners to do a thought experiment. Take the period, if you will, 2000 to 2024, and ask yourself whether your cost of living has increased at 2.6% or some higher number. I would suggest that if you measure inflation personally, and you describe it as the deterioration in the purchasing power of your savings and investments, that the purchasing power of the US dollar is declining by more like 7.5% compounded. Over the last 4 years, Patrick, well, you don't live in the United States, so maybe it isn't fair to ask you. Has gasoline gone up 2.6%? Have grocery prices gone up 2.6%? Has health insurance and healthcare gone up 2.6%? How about rent? The mortgage interest rate has doubled. And how about taxes? The idea that inflation, as I define it, the deterioration in the purchasing power of US dollar savings, is marching along at 2.6% is to me farcical. I'm amused that the people who vote and the people who work and invest uh, now believe that these inflation measures, by measures, I mean the methodology that's used to measure inflation and index, is accurate because it's fiction. It's pure fiction. This isn't a Democratic statement, Patrick. This isn't a Republican statement. This is simple arithmetic. Inflation is with us.
Would you say that currently we're in the environment of disinflation, and then for now anyway, where they are telling us inflation has gone down, but at the same time we are seeing elevated prices, so we are going to see this swing back where prices are going to start to rise once again.
We are in a circumstance that, left to its own devices, would be broadly deflationary. When you liquidate at the end of a credit cycle, when you have defaults, that's deflationary. The policy response to that is inflationary. In other words, we postpone the reckoning around the debt by inflating away the net present value of the debt. We're living in an artificial construct, and I think we're going to live in an artificial construct for the rest of my natural life. What that means as an individual is that you need to understand, if you are on a defined benefit pension plan, or if you think that your university education in the future is going to be funded by an endowment, if you're counting on Social Security or Medicare or Medicaid, understand that you're going to have to make other arrangements. If you are planning for retirement, and if your thinking is around nominal pricing, which is to say, if you have an adequate life now with retirement income of $5,000 or $6,000 a month, and you project forward 10 years, understand that your $5,000 or $6,000 a month will buy you $1,500 worth of goods and services at today's prices looking forward. And you need to make private arrangements to deal with that. And it's important that you begin to do it now. According to the IRS, Patrick, as I said, in the decade of the 1970s, the last time we faced this circumstance, according to government statistics, not some cranky old libertarian Rick Rule, according to government statistics, the US dollar lost 75% of its purchasing power in 10 years. Not coincidentally, the gold price soared. I think it's important to note, too, for all its faults, the US currency is still the best currency in the world. So if you live outside the US, my suspicion is that your outcome will likely be worse, not better. Unless you live in demi-states, Singapore, where you do, as I understand it. But for Americans, I'm not suggesting doom and gloom. I'm just suggesting that if you rely on the Commonwealth in the old-fashioned sense of the word for your future, you're mistaken. You need to rely on yourself.
With the dollar still being sort of the best so-called currency, or the cleanest currency in the hamper, how do you see treasuries sort of reacting, I guess, mid to long term? Or is the dollar still going to be that safe haven asset that people look for?
I think the dollar. I think the dollar will do well relative to other currencies, but I think the dollar will do very poorly uh, in isolation. Let's look at the arithmetic around the U.S. 10-year Treasury, Patrick, in answer to your question. The Treasury pays you 4.4%. And if you believe the CPI stated rate of inflation at 2.6, you're getting a 2.2% real yield. Not great, not bad. You know you're going to get paid, because if they need to, they can print to pay you. But if you change your inflation assumptions to reflect real arithmetic, what you see then is that the purchasing power of your yield and your principal is declining by 7.5% compounded. Now that's brand new arithmetic. If you take 4.4 as the interest number and you subtract 7.5, the deterioration in the purchasing power, what you learn is that in a real sense, you're losing 3% a year, every year for 10 years. The US government is making you a promise, Patrick. If you lend them $1,000 today in a US 10-year treasury, they will give you back 35% less purchasing power 10 years from now. And they guarantee it. That's the first promise they've ever made to me that I believe.
That's a good way to look at it. Hey, Rick, we got the I think the FOMC meeting is right around the corner. What do you see the Fed doing this time around?
I think they're going to be under an awful lot of pressure to either maintain or cut the interest rate. The political clamor from both sides of the aisle is cheaper credit. In other words, penalize savers on behalf of spenders. In a sense, the political class has no choice. With almost $36 trillion in on-balance sheet liabilities, an increase in the nominal interest rate leaves less money in the federal government for them to waste. And that's what they want to do. So my suspicion is that interest rates will either stay the same or they will engineer a 25 basis point rate cut. I don't believe that we will see an end, perhaps even in my lifetime, to artificially low interest rates and credit market manipulation by the Fed. Let's look at what manipulated interest rates are. They're really a political circumstance where you penalize savers, people who have generated economic surplus, on behalf of spenders, or on behalf of relatively few investors like myself who have access to credit and the knowledge to employ it intelligently. What it really is an income transfer from those who save to those who spend and invest. It amuses me that it's so popular.
The 2% target Fed is getting pretty close to it by their measures, by their metrics. Uh, they're going to be claiming that soft landing as well. Are we out of the woods as far as the talk of recessions or maybe stagflation still?
I think we're in stagflation. Uh, there's no doubt in my mind at all. We have an economy that is much stronger than I had anticipated, but it's an economy that isn't working for most Americans. It's working in spades for people like me. You know, this is really truly a Goldilocks moment. But for the rank and file American, it's not working so well. The jobs growth that we have seen statistically is almost all government jobs, which is to say no wealth creation, just wealth redistribution. We have papered over the excesses in the economy, but what people really seem not to understand is the deterioration in their purchasing power. It's even become a political issue. Groceries, food, which is 11% of the average household budget, has become a political issue. It is not that grocery prices have gone up. It's that the purchasing power of the dollar has gone down. The profit margins for grocery chains are notoriously small. And somehow people don't get this. Gasoline prices rise and fall in some measure due to crude oil prices. They also rise mostly due to the difficulties around permitting new refineries. What rises inexorably around gasoline are taxes. So I think it's very clear that we are in stagflation. I think what we have is a situation like we had in the period 1968 to 1972 or 73, where the impact of inflation hadn't been personalized, which is to say that people hadn't recognized it yet. And I think that we're 1 or 2 years away from a popular reckoning around inflation and an understanding, like we had in the 1970s, that this isn't a problem that can be solved in a quarter. It's a problem that needs to be solved over a decade. And we will solve it, by the way. It's just that it's going to take a really ugly period of readjustment, much, I think, like the decade of the 70s. But, Patrick, let me be just completely candid. We are not headed to stagflation. We're in it. In the early innings, to be sure. And it hasn't impacted markets yet because people went through a period, 1982 to 2022, a 40-year period of very benign economic climate. And people's perceptions of the economy are set by the experience over the last 40 years. I would argue that beginning in 2022, things changed. And I think that the pace of change will become increasingly rapid. I think that'll be very good for people who understand it and are prepared for it, which unfortunately I think is a small proportion of the population, and very bad, like the decade of the 1970s were, for people who didn't prepare themselves.
Yeah, I can see that. I completely agree also with what you're saying. Uh, but with that, what measures do you think the Fed will take, and will those measures be politically acceptable? Because the last time when Trump was in office, let's say, he and Paul, they were at odds with the way, the fiscal and monetary policies were supposed to have been run.
I think to really cure the economy, you need to deregulate interest rates. You need the cost of capital to be expressed in the market. And by the way, the market's starting to express itself anyway. You have the Fed cutting nominal rates and the yield on the US 10-year Treasury going up. The idea that the Fed jawbones interest rates lower and the market takes interest rates higher is something that I haven't seen for a very long time. The last time I saw it was 2001. As I say, politics is very transactional. And Trump and the Republicans have made promises to various constituencies. Keeping those promises is likely to require the continuation of an extraordinarily accommodative fiscal policy. I think it was Dick Cheney a long time ago who said during the early part of the Reagan administration, deficits don't matter. What he meant was, in order to win the popular vote, in order to continue with the programs that the nominal right considered to be expedient, that people didn't care particularly about a floating abstraction called a budget. And I think that continues. I think it's unfortunate. And I think just like in the decade of the 70s, there will be a reckoning. And I think the accommodation, as I said earlier in this interview, will be the tolerance through the political class of 10 years of inflation, where the purchasing power of savings declines by 75%.
That the decade of the 70s, even 80s. I remember as a kid, on my way to school, listening to the early morning radio programs, they always mentioned the price of gold, and it seemed to always be the price of gold rising. Today, we frequently hear about $5,000 an ounce gold, 10,000, $50 an ounce gold. Are these numbers plausible with the outlook of the debt still growing, the GDP really growing phenomenally the way it is?
Again, let's look at history and arithmetic. In the decade of the 1970s, with the US dollar losing 75% of its purchasing power, the gold price went from $35 to $850, a 30-fold increase. Let's strip part of that out, just for fun. Let's say that the move from $35 to $100 was due to the legalization of gold ownership, because gold had been price controlled for 40 years? So let's say at the beginning of the decade, just for fun, that gold was $100 an ounce. At the end of the decade, with a 75% deterioration in the purchasing power of the US dollar, gold was at $850, an 8.5-fold gain. Then let's fast forward to the decade 2000 to 2010, the last time the US dollar was under internal assault. At the beginning of that decade, the gold price was $253. At the end of the decade, the gold price was $1,700, a 7-fold increase. Or, just for fun, let's lengthen the time frame. Let's do 2000 until today. At the beginning of the millennium, gold was at $253 an ounce. Now it's $2,600, $2,700. What's that, an 8-fold increase, 9-fold increase? Gold has done exactly what it was supposed to do for the last 24 years. It has maintained its purchasing power. If I'm right, and the decline in the purchasing power of the US dollar is at 7.5%, it was less earlier, and gold increased in value by 8% compounded over 24 years, what gold did is exactly what it was supposed to do. So when people with a short-term orientation, the greed buyers of gold, say, I own it at 27 because I think it can go to 3,200. That number becomes real to them looking at the immediate past. That's not why I own gold. I own gold because I have a visceral memory of the decade of the 1970s when the gold price increased in real terms 8-fold. I own gold not because I hope it'll go to 3,200, but because I'm afraid it's going to go to 9,000 or 10,000. Patrick, I would dearly love to be wrong.
Yeah. How important do you think it is for people to truly understand this? Because I think last time we went over some numbers, I think precious metals or gold was still just a fractional part of people's portfolios.
It's still a fractional part of people's portfolio. And let's do the numbers. According to JP Morgan Chase, the market share of precious metals and precious metals related investments in the United States market is about 0.5%. After a pretty good rise in the gold in the gold price, the 4-decade mean market share was 2%. Gold doesn't have to win the war against the US dollar. We don't have to have a cratering of the treasury market. All we have to do is revert to 4-decade means, and demand for precious metals and precious metals related investments grows 4-fold. Imagine what a 4-fold increase in demand would do to price. Or, if you don't want to look forward like that, look backwards. Look at the decade of the 1970s, or look at the decade 2000 to 2010. Don't overinvest in gold either, because what you learn is that if you regard gold as insurance, a fairly small investment yields pretty good coverage. If, as an example, at the beginning of the decade of the 1970s, you had 10% of your portfolio in gold and 90% in other assets, but let's say just for fun that you had them in the long bond market and the stock market, 60-40 or 40-60. At the end of the decade, you would have lost 35 or 40% of 90%. But in gold, you would have made 8 times your money, which is to say you would have come out of that decade with only a 10% allocation to gold, with your purchasing power, with your wealth maintained. And I think people who ignore history like that are probably going to experience a fairly unpleasant 10 years.
Last question here. You know silver very, very well. Um, Gold was on a run, hitting all-time highs, seemingly once or twice every month or so. Silver still pretty sluggish compared to gold. What would you say the reason is for that?
Again, in my experience, history, uh, I've been through, depending on how you count them, either 3 or 4 precious metals bull market cycles, some fairly short, but they followed a predictable pattern. the market was kicked off by a fear buyer buying physical gold. Gold moved first. After the momentum was established in physical gold, some of the better gold producers began to enjoy better profit margins. There's a delayed reaction to this, of course. But when that happened, the biggest gold producers began to move. And that momentum attracted generalist investors. When the generalist investor became interested in the precious metals narrative, a couple things happened. Going right to your question, perhaps because of the lower unit price of silver, leadership in the precious metals market changed from gold to silver. Silver moved later, but when it moved further and faster. Sorry to keep going back to history, but let's look again at the decade of the 1970s. At the beginning of the period, gold was at $35, price controlled. Silver was at $1.20 or $1.25. At the end of the decade, gold was at $850. Silver was at $50. Let's go back then to 2000. At 2000, gold was at $253. And if my memory serves me well, silver was at $5 or $6. At the end of the decade, gold was at $1,700 and silver was back at $50. When market leadership changes from gold to silver, silver runs further and faster. But it takes longer for it to get started. You may remember, or you may not, I looked at my notes of our last interview, yours and mine, or second to the last interview at the beginning of 2024. And I had suggested to you that the high quality junior stocks as a whole were really, really, really hated. I love to triumph my past successes on those odd occasions where I was right. And I was really right. And I said, I think that these silver stocks are a coiled spring. Not because I think silver needs to do well over 2024, but rather because everybody who possibly wanted to sell these stocks has already done it. They're hated. And we've seen this weird circumstance in 2024 where the high quality silver juniors are uniformly up 2, 3, 3.5 times, while the silver price hasn't moved much. So I would caution you that it may be that in the next stage of the silver bull market, in the beginning of the market, that silver itself, the metal, might outperform the junior stocks because the high quality juniors have already had such a spectacular run. Looking longer term, again, in my experience, Doug Casey famously points out that the market capitalization of high quality junior silvers is so small. And notice that I say high quality. I'm not talking about the really junky guys. That when the generalist investor becomes interested in the space, there isn't enough room. There isn't enough market cap to contain the money. From the point of view of what silver bullion does, which is to say sells silver, you won't need me to tell you when leadership has transitioned from gold to silver. My experience is that when silver runs, you don't need a crystal ball to understand it's running. It really, really, really runs. Is that going to happen in 2025 or 2026? I don't know. What I do know is that when it runs, whether you had to wait 2 years or 3 years, doesn't matter much. You don't have to trust me on this. Just get a silver price chart going back to 1970 and take a look at what happens to the metal when it runs. It is truly, truly, truly astonishing. I have, I think, about 2.5% of my portfolio in silver stocks right now. And I wouldn't be surprised if organically, without any additions from me, it becomes 20% of my portfolio. They're fairly well chosen silver stocks, but the upside in silver stocks in a silver bull market, the upside in silver itself is just breathtaking. Your audience, most of whom is younger than I, don't seem to think in 5 year time frames. They seem to have expectations that are limited to the next long weekend. That's a mistake. I wish I would get quicker gratification too, but it doesn't matter much what you wish for. You have to pay attention to what's on offer. And what's on offer is the probability that we are in a precious metals bull market, led by the deterioration of the purchasing power of the US dollar. If that's true, history suggests that after the narrative has been proven with increasing gold prices and the generalist investor comes down into the space, that leadership in the market changes to silver.
Just want to touch on the minors, since we talked about the juniors. Overall, in your view, what how is the state of the miners, and also considering that we've heard for so long, the solar panel production, needing all this silver, and we've heard about the silver demand not being able to keep up with supply. Are these things starting to factor in?
Well, it's always been difficult for me because I've never understood how to ascertain what real supply is. Um, Traditional holders of silver include, as an example, large parts of the peasantry of India, Bangladesh, Pakistan, and Sri Lanka. They own it because they don't trust their government, which means they're not really good about reporting how much they own. So it's difficult to ascertain what really constitutes supply. I don't know how to do it. It's difficult, too, to understand forward looking supply because new mine supply is only 17 or 18% of new supply in silver. The rest comes from silver production that's a byproduct of mining other metals or from recycling. It's very difficult to generate a supply demand balance if you don't know what the supply is, either new mine supply or above ground supply. So, after that long winded answer, I'm going to duck the question. I don't know. Unlike most other commentators, I know I don't know, and I know they don't know. I look historically at the fact that what has really goosed silver periodically has been investment demand. And investment demand is always a function of silver catching up and then surpassing gold's momentum in a precious metals bull market.
All right, I will take that as it's a good answer. it's it's a good answer. Come to think of it, uh, Rick Ruby. Before we wrap up, can you tell us how we can follow you and support your work?
Sure. If you like what I have to say about natural resources or precious metals investing and you want to personalize it, go to my website, ruleinvestmentmedia.com. One word. List your natural resource stocks, and I personally, for free, no obligation, will rank them 1 to 10, 1 being best, 10 being worst. I'll comment on individual issues if I think my comments might have value. Ruleinvestmentmedia.com, list your natural resource stocks. Please, no crypto. Please, no tech stocks. Please, no pot stocks. Leave an old guy to do what he does. In addition, if you're American or Canadian, and for any reason at all you're unhappy with your current banking relationships, check out Battle Bank. We're starting a bank for people who demand better service or who would like to be paid interest on their savings. You can either go to battlebank.com or at Rule Investment Media in the question and comment section, write bank. We will, I believe, soon be open, and we are looking forward to battling for your business.
Just a question here. If, let's say, when people sent you what they're looking at, were there any that kind of left you scratching your head a bit for a while?
Yeah, at least 3. Most people describe themselves as conservative investors, when in fact they're wild speculators. It's okay to be a speculator, but you need to acknowledge that yourself that you are a speculator, and you need to prepare yourself financially and psychologically for speculation. All the money I now invest conservatively, I made speculating aggressively. So that's the first thing. The second thing is that most people own way too many stocks. way too many stocks. I ask investors, or speculators rather, to own the number of stocks that corresponds with the number of hours per month that they're prepared to spend studying the stocks. If you're prepared to spend 10 hours, then you should own 10 stocks. But many, many, many people whose portfolios I've graded own 60 or 70 stocks. And I know that they're not spending 60 or 70 hours. The third thing that I would suggest is that most investors have very long-term perspectives and narratives, but they have short-term tactics. If you own silver stocks because you think silver is going to go up over 5 years, you need to be prepared to hold them for 5 years. But the idea that you own commodity stocks based on a commodity narrative and you don't allow the investment time to give you compounding means that you set up to fail. There's a contradiction between your strategy and your tactic. And that contradiction between strategy and tactics, I think, is the principal reason why most speculators are losers. Fidelity did a study where they took tens of millions of investors in Fidelity products worldwide, and they segregated those investors into various subgroups: men, women, rich men, Caucasian, Black, Hispanic, blah, 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 all this kind of stuff, right? And they tried to find which investment subgroup did the best, had the best outcome. And you know who it was?
I'm interested. Who was it?
Dead people. People who didn't trade, who didn't fall for the latest hyperbole. It was dead people that outperformed every other subgroup at Fidelity. I'm not suggesting death as an investment strategy. I'm just suggesting that not chasing the latest fad is how one does well.
Rick, I want to thank you again for your support, and I really hope we can do this again soon. And I'm very hopeful that things will unfold in a way that works for everyone, if not most people.
Anytime, Patrick. I look forward to this.
That was Rick Rule sharing his views on the economy and precious metals. To see more of Rick's views and work, please do visit ruleinvestmentsmedia.com. If you like this video, please do subscribe, give it a thumbs up, and share. All are greatly appreciated. Audio-only versions of this interview can be found on iTunes and Spotify.